Hello everyone, I'm Shivani and today we are going to discuss the modern classification of accounts and the rules pertaining to them. I hope you have seen the part 1 of this video where we discuss the golden rules of accountancy pertaining to the traditional classification of accounts. Without understanding those rules, it would be difficult for you to understand the modern classification of accounts. So, without further ado, let's get started. Firstly, we are going to discuss what are assets. Assets are the properties, possessions, or economic resources of a business. Now, these assets can be classified into two types: tangible assets and intangible assets. Tangible assets are those which we can touch by our hand. Intangible assets are those which we cannot touch. So, tangible assets are assets like machinery, plant, vehicles, etc. We can touch a van, we can touch a cotton textile mill, we can touch a truck which transports the goods. On the other hand, if we take into consideration intangible assets, assets like copyright, can we touch a copyright? No, we cannot touch copyright. We cannot touch goodwill, but they all have a value and therefore they are assets of the company. Next, we'll take into consideration fixed assets and current assets. Now, these fixed assets are held for a long time period. Fixed assets are held for a long time period. So, examples are machinery, plant, building, etc. We do not change, rather, the business does not change the furniture every now and then, every month or every year. Rather, it takes a long time for the furniture to undergo depreciation, and for that matter, even machinery. So, these are held for a long time period, whereas current assets are those assets which are held for a short time period. Examples are cash, bank balance, bills receivable, okay, debtors. These are examples of assets which are current assets. So, having understood this, now we move on to what is an asset account. These are accounts which pertain to these economic resources, these assets of the enterprise. Now we'll understand the rule which governs this particular account. Now, we need to understand the rule very carefully. Debit the increase and credit the decrease. Now, what does that mean? Please do not confuse this with the rules that we have learned as part of the traditional classification of accounts. But remember one more thing, that whenever we are doing these entries, whenever we are making these entries, either using either of the sets of rules, we'll arrive at the same transaction, same entries. So that's not a matter of worry. Debit the increase and credit the decrease. That is, whenever an asset is increasing, we will debit that asset's account and credit the corresponding account. Whenever the asset is decreasing, we'll credit the assets account. As you can see in this particular example, when we are purchasing machinery, machinery is coming in, cash is going out. This is a simple way of understanding it. But if we go by the rule, we are debiting the machinery account because the asset is increasing. We are crediting the cash account. Cash account is getting debited in the second case, while the machinery account is getting credited because we sold the asset. We we are selling off the asset, and therefore our asset is decreasing. So, this is the rule which pertains to this particular account. I hope you have understood it. Now, we are going to learn about the liabilities account. Now, in order to understand what is a liability, let me take an example. Suppose I purchase some goods from you on credit. On credit, that means I need to pay an amount of money for those goods in future. So I am your debtor, you are my creditor. This much is clear, I hope. So in my books of accounts, what will I write? I will write bills payable or creditors in the liabilities side of the balance sheet, and hence this will be called my liability which I owe to you. Okay, rather the entity owes to you. So these are the amounts that an entity owes to the outsiders. Now, one more thing that we can think of, that is, one more definition of liability is that even the capital that a business has, it is also a liability. The business has an obligation to pay that amount to the owner. So it is a liability for the business. Now, we can classify it into two types, long term and current liability. Long term liabilities are payable after a period of 1 year or 12 months, whereas short term liabilities, that is current assets, current liabilities, are payable after, like within a period of 1 year. Examples of liabilities, that is long term liabilities, are debentures, bank loans, etc. Whereas current liabilities are creditors, bills payable, which I just told you, rent outstanding, bank overdraft, etc. So, having said that, what is a liability account? What is a liabilities account? A liability account is an account of amounts payable to lenders, creditors for goods outstanding, expenses, etc. Whatever I just discussed. So, now we are going to learn about the rule which governs this particular account. Okay, now in order to understand this rule, we'll take into consideration this particular example. Being cash borrowed, we borrowed some cash, our liability increased. This particular thing is clear, I hope. Our liability is increasing. What does the rule say? Just read the rule once. Credit the increase. So, since our liability is increasing, we'll credit the liabilities account. Since our liability is increasing, we'll credit the liabilities account. So, here we're borrowing some cash from the creditors, so we'll credit that account. Creditors account is getting credited. We are debiting the cash account. Now, suppose I paid back the creditor. Suppose I paid him back. Then what will be the entry? Creditors account debit to cash account credit. Okay. Then what is going to happen? We are debiting the creditors account because our liability is getting decreased. Our liability is decreasing and therefore we are debiting the creditors account. So just remember it like this. Just remember one of the rules, assets account. So whatever the rule is for the assets account, it will be opposite for the liabilities account, because assets and liabilities are basically opposite things, absolutely opposite, shown in the balance sheet. So I hope you have understood this particular rule. Now, what is capital? Capital, also known as owner's equity. It is owner's equity, and this particular amount of money is owed by the business to its owner. Now, I discussed this particular aspect regarding capital, but I'll discuss it again over here. That is, in the famous case of Salomon versus Salomon and Company Limited, it was known that a business, a company, and its owner are separate legal entities. They are not the same. Okay, so that's the reason why when the owner is putting some amount of money into the business, the business owes that amount to the owner. The reason for this particular um, unique aspect of capital is that they are both separate entities according to law. A company is an artificial human being according to law. So it is an obligation of the business. Okay. Now, since capital is a liability, the rule for capital account and liabilities account both are same. So it's very easy to remember. Okay. Now, one more thing. Drawings account is also a capital account. Drawings, what is drawings? It is the amount of cash, goods, assets taken by the owner for personal use from the business. And we deduct the drawings from the capital of the business at the end of the financial year while preparing the balance sheet. Now, the rule. So the rule says credit the increase, debit the decrease, much like that of the liabilities account. Here, I would like you to note one thing. That is, when the owner is withdrawing cash from the business for personal use, we do not make the entry capital account debit to cash account credit. Okay, so there's a reason for that. That is, if we do that, then what will happen? The balance in the capital account will fluctuate very frequently, and it will become very difficult for the business to maintain the account. So therefore, we do not touch the capital account. Rather, we make another account called the drawings account. And that's the reason why we subtract this particular amount at the end of the financial year while preparing the balance sheet. So this is a very interesting point to note. That is so that the capital account does not, the balance of the capital account does not fluctuate frequently. We do not touch it, and rather we create another account called drawings account. So here again, we are crediting the increase and debiting the decrease. Now, since this particular account is a capital account, so whenever the capital of the business is decreasing, we'll debit that particular account. Since drawings account is a capital account, we'll debit that particular account. And then, of course, cash account will get credited. Okay, so this particular aspect is particularly unique to capital and drawings. So please remember that thing. Now, revenue. What is revenue? It is the amount earned by the business for selling goods, rendering services, other incomes like rent received, interest received, dividend earned. These are also revenue. These are also included in the revenue earned by the business. Now, the accounts pertaining to these particular revenue incomes, they are called revenue accounts. So, they are income accounts and therefore they have credit balances. An increase in income is credited while a decrease is debited in amount. In the next slide, we are going to discuss that. So, we are going to debit the decrease and credit the increase. Whenever we have a revenue, we are going to credit the revenue account. In this case, rent received is the revenue, so we are going to credit the rent received account. On the other hand, we are going to debit the cash account. I missed it over here. It will be account to rent received account. So it will go like that. And on the other hand, if there's a decrease in income, we'll credit that, debit that account in case of increase and credit in case of increase. I hope it's clear with the help of this particular example. Now, expense account. What is an expense account? It is the cost incurred by a business firm in order to earn revenue. A very simple definition. So, there's a difference between an expense and an expenditure. When an expense is exhausted within a period of 1 year, it is called, when money spent is exhausted within a period of 1 year, it is called expense. Whereas if it lasts for more than a year, it is called expenditure. Now, the purchase of goods is expenditure. Okay. While the cost of goods sold is an expense, for example, rent paid, salary paid, electricity charges. Now, it's not important um, to understand what is expenditure in this case, but I gave this as an extra information. Now, if we try to understand this particular account, we are seeing all expenses are included in this account. Rent paid, salary paid, wages paid, all these are expenses. So the rule pertaining to this particular account will be opposite to that of revenue account. Okay. So debit the increase and credit the decrease. Debit the increase, credit the decrease. So whenever our expenses are increasing, We'll debit the expense account. Whenever our expenses are decreasing, we will credit that account. As simple as that. Wages account is getting debited because we are paying the wages. We are crediting the cash account. Cash is going out of the business. Okay. So I hope you have understood this. Thank you for watching, and if you still have any particular doubt relating to the accounts or the rules, you can put it in the comment section. I'll clarify those doubts as and when it's possible for me. Thank you for watching.